Okay, let's unpack this. $9.38 billion. That's what Foot Locker's market cap was, what, back in 2016?
Yeah, quite something.
And now, as we're sitting here, May 2025, it's shrunk to just $1.22 billion.
It's a staggering drop, really.
Absolutely staggering. So I guess the burning question for anyone looking at this from a value perspective has to be, is Foot Locker just a classic value trap?
Yeah.
Is it destined to keep falling?
Right.
Or is there actually a compelling opportunity hidden in that collapse? Could it be seriously undervalued right now?
That's exactly what we need to dig into today. This deep dive is all about figuring that out.
And we've got some pretty detailed research to work with here. A comprehensive report that really looks at everything, the core business, the management strategy, the financials, where they stand in the market.
Right.
So our mission really is to pull out the most critical bits from all this research, help you, the listener, get a clear handle on the potential, but also, importantly, the risks involved with Foot Locker right now.
And it's definitely not a simple picture, is it? No, far from it. It's complex.
Okay, so maybe before we get into the wider market stuff, let's just nail down the basics. What is Foot Locker today, and how does it actually make money, especially given that huge value drop?
Sure. So at its core, Foot Locker is a global retailer. They specialize in athletic footwear and apparel. They've really leaned into this identity around sneaker culture.
Targeting the enthusiast, younger crowd mainly.
Exactly. And they still have a big physical footprint, somewhere around 2,400 to 2,500 stores across 26 countries, plus some licensed spots.
Okay, and how are they bringing in the cash? Still mostly the physical stores, or has online shifted things dramatically?
Well, the physical stores are definitely still the main engine, but you're right, the digital side is becoming much more significant.
Right.
In their last fiscal year, FY 2024, e-commerce was about 18.2% of revenue.
Okay.
And they've got this target, pretty ambitious, to hit 25% by 2026. There's also a tiny bit from licensing, but it's minor.
So, still heavily weighted to physical, but a clear digital push. Now, you think Foot Locker, you think sneakers, that's still the heart of it?
Oh, absolutely. Spot on. Footwear dominates. It was roughly 84% of their sales in FY24.
Wow, 84%.
Yeah. And they carry all the big names. Nike is obviously huge for them, but also Adidas, New Balance, Puma, plus those newer, hotter brands like Hoka and On.
Okay.
And then lifestyle stuff too, like Crocs, UGG. Interestingly, they're also pushing their own private labels now, LCKR for men, Koozie for women.
Trying to build some direct brand power, maybe reduce reliance on the big guys.
That seems to be the idea, yeah. Build some loyalty that's just theirs.
Makes sense. Okay, let's zoom out a bit.
Right.
What about the overall industry? Is the sportswear market healthy, growing?
The global sportswear market is definitely big, and it's still growing. Projections suggest it could hit over, $855 billion by 2033?
Huge numbers.
Yeah. And the athletic footwear part, which is Foot Locker's main playground, that was valued around $132.7 billion just this year, 2025. It's expected to grow at a CAGR, a compound annual growth rate of about 3.9%.
So steady growth, what's driving that?
A few things, really. The ongoing focus on health and wellness, obviously. Athleisure wear isn't going away. There's also growing interest in sustainability, though that can be a bit sensitive to economic bumps.
Sure.
Plus, tech advancements in shoes and gear, customization, and just the continued rise of e-commerce.
Okay, so on paper, growing market, decent trends.
Yeah.
Which makes that market cap crash even weirder. What's the competition like? Is that the missing piece?
The competition. Yes, it's intense, and it comes from all angles.
Like who?
You've got other specialty stores, think Finish Line, big sporting goods chains like DIC Kess, department stores still play a role. Then there's the massive online retail space.
Right.
But maybe the biggest threat, the one that really hits home for Foot Locker, comes from their own suppliers, especially Nike.
The direct-to-consumer, the DTC push.
Exactly. Nike, Adidas, they're all building their own direct channels, selling straight to the customer. That cuts out the middleman, which traditionally was Foot Locker.
That feels like a fundamental challenge to their model.
It is. And then you also have these agile, fast-growing brands like Lululemon, On, Hoka, really capturing consumer attention and loyalty.
Right. So that DTC threat, particularly from Nike, must really undermine any kind of competitive advantage or economic moat that Foot Locker used to have. Did they even have one?
Historically, yeah, you could argue they did. They had strong global brand recognition, a huge network of stores, often in prime locations.
Hmm.
For a long time, they had a dominant share of the U.S. sneaker market. Those relationships with the big brands were key assets. And,
Yeah.
people talk about the stripers, their store staff, their knowledge being a plus.
But it sounds like that's all crumbling a bit.
It definitely seems eroded. That supplier power shift is huge. We saw Nike go from, what was it, 75% of Foot Locker's purchases in fiscal 21.
75%? Wow.
Yeah, down to 59% in fiscal 24.
Still a massive chunk, but a significant drop.
It really shows the impact of Nike's DTC strategy and how Foot Locker desperately needs to diversify, which is tough when Nike is so dominant. And on top of that, the current retail environment is super promotional, hitting their pricing power.
Okay, so they're facing serious headwinds.
Oh.
What are they doing about it? They have this lace-up plan, right? What's that involve?
Yes. The Lace-Up Plan is their big strategic response. It's built around a few key ideas.
Like,
One is expanding sneaker culture, basically trying to broaden their appeal beyond just the hardcore sneakerhead. Another is powering up the portfolio. That means refreshing stores, moving more off-mall, testing these new reimagined store concepts.
off-mall, interesting, okay.
Then there's deepening customer relationships, mainly through their FLX Rewards loyalty program, building a best-in-class omni-channel experience linking online and physical stores smoothly. And finally, simplify operations, which involves things like streamlining internationally and moving their HQ.
It sounds pretty comprehensive. But I guess the multi-billion-dollar question literally is, can this plan actually rebuild a lasting advantage for them in this new reality?
That is the question. Its success really depends on whether they can create a truly distinct customer experience and build loyalty that isn't just about having the latest Nike drop. Right now, that Nike reliance looks more like a weakness than a moat.
Okay, tough landscape, questions about their edge. Let's switch to the leadership. Who's steering the ship through all this?
The CEO is Mary Dillon. She came on board in September 2022.
Right, I remember that. She came from Ulta Beauty, didn't she? Had a great run there.
Exactly. Very strong reputation from Ulta, plus experience at McDonald's, PepsiCo. She's actually one of only 3 women, I think, to have led 2 Fortune 500s.
Impressive resume. What about her stake in the company and compensation?
Her pay in FY24 was around $12.5 to $13 million. Direct ownership is pretty small, about 0.066%. And yeah, since she arrived, she's brought in several new key executives, too.
Okay, seems like relevant experience for a consumer turnaround. And this lace-up plan we just talked about, that was launched under her leadership.
Yes, initiated in 2023.
Have we seen any, I don't know, green shoots, any early signs that might be working?
Well, in the last fiscal year, FY24, there were some, let's say, encouraging signs. Comparable store sales were actually up slightly, 1.4%.
Okay.
Gross margin improved a bit by 120 basis points up to 28.9%. And they generated positive free cash flow again, $105 million.
Positive free cash flow is definitely better than negative, so some potential momentum. How are they using their capital now? Reinvesting? Dividends?
Right.
Buybacks?
They are definitely reinvesting. CapEx in FY24 was $240 million, mostly store remodels, new stores, tech upgrades. And the plan for FY25 is even higher, $270 million. Really focusing on those reimagined stores you mentioned. Management says those are giving decent cash-on-cash returns.
That's positive. What about shareholder returns? Dividends, buybacks?
Well, dividends got suspended back in 2024. The last payout was October 23. They used to pay one, but not right now. And share buybacks. Nothing in the last few years, FY22 through 24. They do have a $1.2 billion program authorized back in early 22, with nearly $1 billion left on it.
But they're not using it, even with the stock price so low.
Apparently not. S&P global analysts, for instance, don't expect them to resume buybacks this year, in 2025.
Suspending the dividend to reinvest makes sense in a turnaround, but not buying back shares at these prices. That's interesting. It makes you wonder what management really thinks the shares are worth.
Yeah, it's a point to consider. Maybe they feel reinvesting in the stores offers a better return right now. Or maybe they're just conserving cash given the uncertainties.
Could be. What about the oversight? Corporate governance, the board, anything noteworthy there?
They recently expanded the board to 11 members, added 2 new independent directors in January 25, one from Gap, one from Ace Hardware. Seems like relevant experience.
Okay.
They have a non-executive chair. The upcoming annual meeting proxy lists 9 director nominees. Those new directors are on key committees: audit, compensation, technology.
Standard stuff. What about pay? Any shareholder votes?
Yeah, there's the usual advisory, say, on pay vote. Interestingly, the CEO's total pay actually went down in FY24 compared to FY23. The structure is typical: salary, incentives, equity.
Right. Anything else jump out from the proxy?
There is a shareholder proposal about setting greenhouse gas reduction targets aligned with the Paris Agreement. The board is recommending shareholders vote against it.
Becoming more common, those proposals. And insider ownership, besides the CDO's 0.066%.
All directors and execs together hold about 0.59% as of March 2025, so still pretty low overall.
Okay, so standard governance, board refresh, lowish insider ownership. The key question for investors, though, does this management team seem rational? Are they focused on long-term value?
Well, look, they brought in an experienced CEO. They launched a clear strategic plan, the Lace Up plan, to address the obvious problems. Their communication seems pretty transparent.
So the right initial moves, maybe?
It appears that way. They seem to be tackling the challenges deliberately. Now, whether they can actually execute effectively and deliver better financial results, that's the big unknown. But the intent seems focused on long-term value creation.
All right, let's pivot to those financials then. We touched on some positive signs in FY24, but what does the longer-term historical performance really show?
Yeah, the longer view, it paints a pretty stark picture of recent struggles. Revenue has been basically flat or declining for several years. FY24 was just under $8 billion, down 2.2% from the year before, and significantly down from peaks a few years back.
And the profitability trend, that sounds even more concerning.
That's really the crux of it. Gross margin did tick up a bit in FY24 to around 29%, which is good, but still below their historical range of, say, 31% to 34%.
Okay.
But the real pain is further down the income statement. Operating margin in FY24 was razor thin, 1.29%.
Wow, just over 1%.
Yeah, a massive drop from previous years. Net income was only $12 million, or 0.13 per share. Compare that to FY22 when EPS was $3.58, or FY21 when it was $8.61.
$8.61 down to 13 cents. Ouch.
And FY23 was actually a net loss, negative $3.51 EPS. So yeah, the profitability has just collapsed. That's a huge red flag.
It really highlights the scale of the problem. But what about the balance sheet? Is the company financially stable, at least? Do they have staying power?
On that front, things look reasonably okay. Their debt level is pretty low, about $446 million total debt. That gives them a low debt-to-equity ratio, around 0.15.
So not overloaded with debt.
No. And liquidity looks decent, too. They had about $401 million in cash at the start of Feb 2025. Plus, they have an undrawn $600 million revolving credit line available until 2029. Working capital ratio looks healthy, too, about 2.74.
Okay, so they have some cushion.
Yeah.
And free cash flow turned positive again.
Yes, $105 million in FY24, which was definitely an improvement after 2 negative years. But still, pretty modest compared to $8 billion in revenue. S&P Global is projecting maybe $86 million for FY25.
So balance sheet provides some breathing room, but the core profit engine is sputtering badly. That's quite the mix. What do the returns on capital look like? ROE, ROIC.
Yeah, this really reflects that weak profitability. They're very low. Trailing 12-month return on equity as of Jan 25 was just 0.42%.
Less than 0.5%.
Exactly. And return on invested capital, ROIC, was maybe 1.8%. Both are way down from historical levels and almost certainly below their cost of capital, meaning right now the business isn't really generating value on the money invested in it.
Not what you want to see. Any bright spots in operational metrics? Inventory?
They did improve inventory turns slightly in FY24, up to 2.8x, so a bit better at managing stock. Their cash conversion cycle is around 81 days, which isn't terrible, but reflects inventory taking about 98 days to sell.
Okay, so summing up the financial health. Stable balance sheet, but really weak profitability and poor returns. Would you call it robust or sustainable right now?
Precarious might be a better word. The balance sheet gives them time and flexibility, which is crucial. But that weak profit engine is a serious, serious concern. Those recent small improvements are good, but they need way more, and consistently, to call it truly robust and sustainable health. They have a foundation, but it's not earning much right now.
Understood. Okay, we've got a handle on the company itself. How is the wider market viewing Foot Locker? What's the sentiment out there?
Well, looking at Wall Street analysts around mid-May 2025, the general feeling seems cautious. The consensus rating is basically a hold.
So neutral.
Yeah, a mix of buys, holds, and sells. The average 12-month price target is around $17.64, which from current levels implies maybe, 32.5% potential upside
Decent upside if we hit that target.
if they hit it. But it's worth noting several analysts like Barclays and Morgan Stanley have actually lowered their targets recently, so that might signal growing concern about the near term.
Okay. And there was some buzz about a potential takeover too, wasn't there?
Yes, just recently, May 14th, a report surfaced suggesting DICK Sporting Goods might be interested. The rumor mentioned a price around $24 a share.
$24. That'd be a nice premium.
It would, but, and this is critical, it's just a rumor at this stage, you absolutely cannot base investment decisions on that kind of speculation.
Good point. Very important disclaimer. What about short interest? That often tells a story about market skepticism.
It certainly does here. Short interest in Foot Locker is noticeably high. Around 15% to 16% of the float was short as of late April, early May.
15 to 16%, that's significant.
It really is. It shows a lot of investors are betting against the stock, expecting the price to fall further. The days to cover is around 4 days, also pointing to pretty strong bearish sentiment.
So overall market view seems pretty wary, maybe even negative in some pockets. Let's look at who actually owns the stock. What's the ownership structure like?
Institutions own a big chunk. Data suggests over 600 institutional owners holding around 120 million shares.
Who are the big players?
The usual suspects, really. BlackRock, Vanguard are the largest. Dimensional Fund Advisors is up there, too. And interestingly, Vesa Equity holds a significant stake, over 10%.
Vesa Equity. Aren't they sometimes seen as activist investors?
They have that reputation, yes. So their presence is definitely noteworthy, could signal they might push for changes.
Okay. And what about insiders, management, and the board?
As we mentioned, it's pretty low. CEO Mary Dillon around 0.066%. All directors and execs combined own just about 0.59% as of March 25, per the proxy.
So big institutions dominate, potential activists in the mix. Insiders have relatively little skin in the game directly through shares. What does that tell us?
Well, high institutional ownership is normal for a company this size. The low insider ownership, though, sometimes that raises questions about alignment with common shareholders. And Vesa Equity's stake, that just adds another layer. They could push for strategic shifts, operational changes, maybe even asset sales if they think it unlocks value. Definitely something to watch.
Okay, makes sense. We've covered a lot. Now let's try to synthesize this with a SWOT analysis. Strengths, weaknesses, opportunities, threats. What are Foot Locker's core strengths right now?
Okay, strengths. They still have that established brand name, global reach. They have the lace-up plan, a roadmap, an experienced CEO. Their FLX rewards program seems to be gaining traction. We saw those recent small upticks in performance. And some operational metrics aren't too bad.
Right. And the weaknesses, what's holding them back?
The weaknesses are pretty significant. That massive supplier concentration, mainly Nike. Profitability has cratered. Their store portfolio is challenged, too much mall exposure maybe. The Champs banner seems weak. You could argue there was past underinvestment. And yeah, some key operational metrics are worse than they used to be.
Okay. What about opportunities? Where could they find growth or improvement?
There are definitely opportunities. Expanding those private labels, LCKR and Cozy, could boost margins and loyalty. If those reimagined stores really work, that's a plus. There's growth potential in the women's segment. Continued digital expansion. Maybe gaining market share if competitors stumble.
Okay.
Optimizing their international business.
So avenues exist.
Yeah.
But then the threats. What are the big external risks looming?
Threats are serious. You've got the constant, intense competition from everywhere, DTC, online, other retailers. Shifting consumer tastes are always a risk. Economic downturns hit them hard. But the biggest, most immediate threat right now, it really looks like these new U.S. tariffs hitting in 2025.
Right, the tariffs. Let's really drill down on those. What are the specifics and what's the potential damage to Foot Locker?
Okay, the new regime involves hefty increases. A 46% hike on goods from Vietnam, 32% on Indonesia.
46%.
Yeah. And think about it. Something like 97% of apparel and footwear sold in the U.S. comes from those regions, plus China. These tariffs are on top of existing duties. Plus, there's a new 10% universal tariff added on.
So this hits Foot Locker right where they source.
Directly. They rely heavily on those countries. The impact could be severe. Their cost of goods sold will almost certainly jump, squeezing those already thin margins even further.
Can they just pass the cost on to consumers?
They can try, but raise prices too much, especially now, and demand could just evaporate. Sales volume could drop significantly. Some industry estimates are talking about potential price hikes up to 54% industry-wide. Imagine what that does to foot traffic.
Yeah, that's huge.
It could also mess with inventory, supply chains, and if some competitors are better insulated, Foot Locker is at a disadvantage. Critically, their FY25 guidance probably didn't fully factor in these massive tariff hikes.
So this tariff situation sounds like a massive, maybe existential threat right now.
Mm.
Are there other major risks besides the tariffs?
Absolutely. That Nike dependency isn't going away. Any further shift in Nike's strategy is a risk. The intense competition is constant. Economic sensitivity is key. Fashion risk is real, especially as they build private labels guessed wrong and you're stuck with inventory. And then there's just plain execution risk. Can they actually pull off the lace-up plan effectively under all this pressure? Big transformations are never easy.
Okay. So weighing all the strengths, the opportunities, but against these really significant weaknesses, and especially these tariff threats, what's the brief takeaway for a value investor looking at Foot Locker today?
It's just incredibly complex. You've got this deeply depressed valuation reflecting massive market skepticism. That's clear. You have a new team, a turnaround plan, some tiny early positive signs. But you also have huge competitive hurdles, and now these potentially crippling tariffs landing right on top of everything.
Which loops us right back to where we started.
Yeah.
Value trap or compelling opportunity. After diving deep, what's the verdict? Still up in the air.
Very much still up in the air, I'd say. It really feels like it hinges on two massive unknowns right now. First, what is the real sustained impact of these tariffs going to be, and can Foot Locker navigate that? Second, can the lace-up plan gain real traction and deliver significant, lasting improvement despite these headwinds? Until we see much clearer evidence on both fronts, particularly on profitability and returns, it's incredibly hard to say if this is a bargain or a falling knife.
It's a great summary of a really tricky situation. And it kind of leads perfectly into a final thought, maybe a provocative one, for you, the listener, to chew on.
Okay.
Given these tariff headwinds, which could just crush their traditional model, could Foot Locker's future value actually lie less in selling sneakers and maybe more in the potential value of its real estate, especially as it shifts to these off-mall locations? Or perhaps as the most likely outcome now, some kind of strategic acquisition, like that DICK's rumor hinted at. Is that the end game?
That's definitely a provocative thought. It really underscores just how uncertain Foot Locker's path forward looks right now. What is the core value proposition going forward?
Something to really think about. We absolutely encourage everyone listening to dig into the sources. All the links are in the description. Do your own homework based on what we've discussed.
Definitely.
And hey, if you found this deep dive helpful, please subscribe to the Stock Analytics AI YouTube channel. We do these in-depth analyses regularly.
And just the standard but important reminder. This discussion is based on research available as of May 15th, 2025. It's purely for informational purposes. It is not financial or investment advice. And please be aware, AI was used in preparing the underlying research materials.